Hey everyone, welcome back to the channel. I'm Divya Grover, here to help you take informed mutual fund investment decisions. When people talk about mutual funds with very large assets under management or AUM, there's usually one common concern that comes up. Can a fund become too big to perform well? The assumption is that once a mutual fund reaches a massive size, managing returns becomes more difficult. But interestingly, several large mutual funds continue to generate steady returns by adapting their strategies to handle scale effectively. These funds usually focus on highly liquid securities like large cap stocks, which makes it easier to execute large transactions. Their large asset base also allows them to diversify widely across sectors and companies, helping reduce risk and improve stability. And in many cases, they follow a long-term buy and hold strategy, benefiting from compounding while also keeping transaction costs lower. So in this video, we are taking a deep dive into one of India's largest mutual funds, HDFC Balanced Advantage Fund, and understanding what's really behind its Rs 1 trillion AUM milestone. Let's start with a quick overview of the fund. Launched in February 1994, HDFC Balanced Advantage Fund is one of the largest schemes not just in the Balanced Advantage Fund category, but across equity-oriented mutual funds overall. As of March 2026, the fund had an average AUM of Rs 1 trillion, making it second only to Parag Parikh FlexiCap in terms of size. Now some long-term investors may remember this scheme by its earlier name, HDFC Prudence Fund. In 2018, it merged with HDFC Growth Fund to form what is now known as HDFC Balanced Advantage Fund. Despite the merger, the core investment philosophy remained largely unchanged. Under its current mandate, the fund has the flexibility to dynamically allocate assets between equity and debt. However, it consistently maintains an equity-oriented structure so investors can continue to receiving the benefit of equity taxation. A major reason behind the fund's popularity has been its strong long-term capital growth, and much of that success is often associated with its former star fund manager, Mr. Prashant Jain, who became widely known for his high-conviction stock-picking style. Currently, the fund is managed by Mr. Gopal Agarwal for the equity portion and Mr. Srinivasan Ramamurthy for the debt portion. Both come with extensive experience in the field of research and fund management. Now let's understand the investment strategy behind the fund. For the equity portion, the fund aims to build a diversified portfolio across industries, sectors, and market caps, while maintaining an acceptable balance between risk and reward. Stock selection is based on quality assessment, earnings outlook, and valuations. The fund follows a bottom-up strategy to identify high-quality, growth-oriented businesses for the long term. On the debt side, the fund has the flexibility to invest across a wide range of debt and money market instruments with varying credit profiles and maturities. Its debt investments are guided by factors like credit quality, liquidity, interest rate outlook, and overall safety. In fact, the fund prioritizes safety and liquidity over chasing higher returns, which is reflected in its large exposure to highly rated debt instruments. Now the big question, how has the fund actually performed over time? Historically, HDFC Balanced Advantage Fund has managed to outperform its category peers and the index by a meaningful margin. There was a period between 2018 and early 2020 when growth remained relatively muted. But once markets started recovering and trending upward, the fund staged a strong comeback. On a rolling return basis over the last 3-year and 5-year period, the fund has significantly outperformed the benchmark as well as many category peers. One notable pattern though is that the fund tends to underperform the category average during bearish market phases. But during bullish phases, its performance has been often exceptional. Coming to risk and reward, the volatility of HDFC Balanced Advantage Fund has been marginally higher than both the benchmark and several peers. However, thanks to strong returns in recent years, the fund has delivered excellent risk-adjusted returns. This is reflected in metrics like the Sharpe ratio and Sortino ratio, where the fund currently ranks among the best in the category and well ahead of the benchmark. Now let's look at the portfolio strategy in more detail. Typically, HDFC Balanced Advantage Fund allocates around 65 to 70% of its assets towards equities and roughly 25 to 30% towards debt instruments. Within equities, the fund invests across market caps, but maintains a clear large cap bias. As of March 2026, the fund held a portfolio of 150 stocks, with the top 10 stocks accounting for 30.6% of the total assets. In fact, the top 20 stocks alone made up 43% of the portfolio, which also means that the fund has a long tail of more than 130 stocks, where each holding has less than 1% allocation. Among the major holdings are large cap names like ICICI Bank, HDFC Bank, Reliance Industries, SBI, and Bharti Airtel. The fund also follows a long-term holding strategy, reflected in its relatively low turnover ratio of 10 to 30%. At present, the portfolio allocation stands at 52.5% in large caps, 9.1% in mid caps, and 6.5% in small caps. On the debt side, the focus is mainly on AAA rated corporate debt instruments along with sovereign rated government securities. Currently, exposure to these stands at 16.7% and 10.1% respectively. So what's the final takeaway here? With a history of more than 3 decades, HDFC Balanced Advantage Fund has consistently delivered above average returns and established itself as one of the top performers in its category. Yes, the fund has faced challenges during market downturns, but over time it has repeatedly demonstrated resilience by recovering strongly during rising markets. Its diversified approach across equity and debt helps it navigate different market cycles more effectively. Within equities, the focus on large cap stocks provides stability and consistency. And on the debt side, the allocation towards government securities adds a layer of safety and liquidity. Overall, the fund strategy is centered around balancing growth potential with risk management, which has helped maintain investor confidence over the year. But as always, there is one important thing investors should remember. Past performance alone should never be the only reason to select a mutual fund. Before investing, always make sure the fund's objective aligns properly with your financial goals and risk profile. Because ultimately, the best investment is the one that fits your long-term strategy, not just the one with a strong track record. Mutual fund investments are subject to market risk. Read all scheme-related documents carefully. Registration granted by SEBI, enlistment as RA and IA with exchange, and certification from NISM in no way guarantee performance of the intermediary or provide any assurance of returns to investors. Investment in securities market are subject to market risk. Read all the related documents carefully before investing.